Something major just changed in China's economy, something that wasn't supposed to happen. And the risk is now it's going to spread to the rest of the world. Now, I want you to understand, since the pandemic, China has dumped trillions of dollars into its economy into various forms of stimulus. They've issued debt. They've done asset swaps. They've cut interest rates. They tried to prop up their currency, and yet none of it worked. And they were doing it to prop up their housing market, which is a major part of their economy. They pumped the banks full of money to keep them from going insolvent. And then on the onset of the trade war, they went out and dumped even more money into the economy to spur domestic consumption. The problem is none of it worked. And what just happened in China? Well, nobody around the world is ready for it, because what happened there is going to spread all across the world and in a major way. As you're about to find out, they're screwed. But the problem is, we're not far behind. And tonight's show is brought to you by Upexi. You can find them on the NASDAQ under symbol UPXI, and they're building the next generation in crypto treasury model. And their stock just closed over its 6-month volume profile and is coming out of deep oversold territory. This is one trade you don't want to miss. Stay tuned to the end of the show or check out the pinned comment or description for more information. Now let's over to Bloomberg, where we picked today's story up as China's producer deflation worsens as weak demand persists. And we've been noting that the Western media has continued to say that China's economy is heading into recession, and we've noted, based on what's going on in their banks, that they could be on the cusp of an all-out financial crisis. But a lot of insiders in China said, look, that's not true. Our economy is stable, it's booming, but what we're finding out right now is demand is plunging. This is playing out just as we predicted it would, and that all that stimulus that China did isn't working, which means they're probably going to have to do a lot more. The problem is, it's going to have some major unintended consequences. Factory deflation persisted into a 33rd month, with producer price index falling 3.6% from a year earlier. So all of this stimulus, all of this demand that they were trying to create by getting consumers to go out and spend, it didn't work. And again, one of the problems with China's economy is they're so tied to the rest of the world that as the rest of the world slows down, again, they're the manufacturing hub of the world. So that means they're facing an impact of demand. Producer prices now, again, contracting for the 33rd straight month. This is a major problem. The consumer price index unexpectedly increased 0.1% and ended a 4-month falling streak, although it's likely reflected the short-term effect of government subsidies rather than a lasting recovery in confidence. And confidence is everything in a debt-based, consumption-based economy, because when people are confident about their financial future, they go out and spend big. But let's first talk about the link between producer prices and consumer prices, because what we're seeing in China is evidence that there's going to be further deflation. And again, for a debt-based economy, this is how you get bubbles. This is how you get financial crises, is when prices start to deflate. And now you can see the U.S. Consumer Price Index in blue against the producer price in red. That's for final demand. And what you can see throughout history, the two generally follow each other, with the CPI following usually the PPI with a lag. Now, there's a couple times where we can go back to 2011, around 2021, and even here currently, where the PPI is rising against a slowing consumer price index. And what that's an indication, at least in our economy, is demand is going down and that consumers can't afford higher prices. The difference in China from what we're seeing is they're choosing not to spend. Again, it's a confidence issue. But if you were worried about losing your job, you probably wouldn't spend as much either, and that's the issue they're facing. The still weak inflation may keep pressure on policymakers to ramp up stimulus to escape a vicious cycle of falling prices, business profits, and wages. But here's a big issue. Cutthroat competition between companies has also added to the deflationary pressures as they engage in ruthless price wars that policymakers now seek to curb. So you can see why China's economy is screwed and why this is going to spread to the rest of the world. Because as demand goes down, businesses are going to fight for whatever customers they can get. And in the case of our economies, what it means is they're going to have to cut prices. The problem is there's something else they're going to have to cut right along with it. But let's talk about the importance of what happens when you see deflation, and that means you see cuts to the labor market as well. Let's now overlay continued claims. Again, back to U.S. data. That's shown in green, and what you can see is going back to 2015 and 2016, there wasn't an impact. The U.S. economy was strong enough to absorb the deflation coming out of China that impacted U.S. consumer prices. But back in 2018, the economy wasn't as strong as we saw consumer prices and producer prices cool off. You could see it had an impact. Continued claims flattened out there. But let's move forward to 2022, because as we saw a lot of disinflation in the factory sector, we also saw disinflation in the labor market, meaning there was a lack of need for employees. People went to the unemployment line and got stuck there. But something we think is going to surge a whole lot higher. That's the stock for our sponsor of today's show, Upexi. Again, you can find them on the NASDAQ under the symbol UPXI, and I think this is one trade you don't want to miss. Look at the RSI and the MACD. You see it's coming out deep oversold territory. How about the 6-month volume profile? The stock went right beneath it, held it, and is now looking to rally up into that higher supply zone. Again, you can find them on the NASDAQ under the symbol UPXI. Stay tuned to the end of the show for more information. But economists have cautioned that Beijing needs more sustainable measures to revise sentiment. New consumer confidence index shows stronger policy support since late 2024 has failed to significantly lift confidence, mainly because improvement in job prospects and income growth have been limited. And we've noted that that's exactly what we see in consumer confidence surveys all around the world. It's about finances, it's about jobs, it's about income. And when the prospect of a slowing labor market starts to hit workers, they realize their confidence goes down and their spending goes right along with it. But there's a problem here. They're trying to revive sentiment, and governments think stimulus works. But as we pointed out, and as you see very clearly in China, it's not working at all. And as you're going to find out, it means that they're completely screwed as more businesses fight for what little business they have. You're going to find out it's going to lead to further deflation, and that ultimately is going to lead to more people on the unemployment line that's going to spread all over the world. But let's talk about the relationship between consumer sentiment and final demand. That for the producer price index still shown in red. And you can see back in 2011, sentiment plunges, and then with the lag, as demand goes down, the producer price index goes with it. Usually it happened during the pandemic. You can see it in 2021. Confidence falls right along with the stock market, and then with the lag, producer prices go down as inventory building starts to catch up. Now we're seeing it happen again. Workers are worried about their finances. They're worried about their job prospects. We talked about this in the recent data we got from the New York Fed, that people, while they're a little more confident that they're going to keep their job, they're worried that if they lose it, they won't be able to get another one, and that has a major impact on spending. Deflationary pressures have also been exacerbated by overcapacity across various industries, and this is something we're going to see a lot more of. Because remember, post-pandemic, there was all this money being flooded into the global economy, consumption surged, and so too did the demand for goods and then eventually services. The problem is governments around the world want to keep it at those levels, but without all of that stimulus, without all of that money, we can't do that, and that's a major problem, because what's going to happen here is this overcapacity is going to lead to a fight to lower prices, to maintain jobs, to maintain production and businesses. And what's going to happen? You're going to see a lot of people lose their job, and then you're going to see a lot of businesses fail. And while Chinese leaders have vowed to cut output in some industries, some analysts warned that the price wars would continue for years as local officials seek to avoid job losses, because again, when people lose their job, that's when things start to go wrong. And what this means for China, well, if we see further slowdown, there's no reason why stimulus can't ramp up again. But the problem for China is the stimulus hasn't worked. In fact, it's put downward pressure on the yuan, which they've had to come in and put support underneath that. So could you imagine if China came out and said, look, we're going to do another couple $1 trillion in stimulus. We're going to cut rates. It means the yuan is going to plunge in value. It's a big risk to their economy, particularly at a time where the dollar's been weakening and they've been trying to get people to trade in their currency. This would be a major problem. But again, this cannibalization, this fighting among businesses for what little business is out there, is going to spread all across the world. And then what we're going to find out is exactly what's going on in China is going to happen elsewhere. Let's turn to Canada, where we can already see some signs of it. As Canadians' job security gets shakier as a trade war harms growth. The percentage of Canadians who believe their jobs are secure or somewhat secure has fallen below 60% for the first time in more than a year. So what we're seeing in Canada is some of the similar things we're seeing here in the U.S., some of the same things we're seeing in China. There's a reason Chinese consumers aren't spending. They're worried about their job. And about 30% say they're unsure, the biggest proportion since 2023. And the Canadian labor market has softened with 4 straight months of either minimal job growth or outright losses. The unemployment rate now at 7% in May, the highest level since 2016, excluding the pandemic. Meanwhile, employment in manufacturing and other trade-sensitive areas of the economy has been affected by trade tariffs, meaning it's likely to get worse. And as it gets worse, and we have all this inventory that got built up ahead of the trade war, what you're seeing is people get worried about their jobs, they're going to cut their spending, and next thing you know, you're going to see producer prices plunging all around the world. It's going to take consumer prices with it. And here's the evidence. Let's now overlay advanced retail sales in blue, again, back to U.S. data against the producer price index, again, still for final demand in red. And you can see as consumers cut their spending back here around 2011 into 2013, what happens? Demand at the producer level goes down. And you can see it works in reverse. As demand goes up, producer prices follow. But now what we're seeing in China, it's likely to happen here in America because we're seeing demand from countries all around the world going down. Consumers are running out of money, they're spending less, and this means, at least in China's case, there's going to be a lot more stimulus coming. The problem is, for a lot of other countries, there just isn't the capacity to do that, meaning the next thing we're likely to see, just more rate cuts. The weak labor market is one reason traders are pricing in another rate cut from the Bank of Canada later this year. The central bank has lowered its policy interest rate to 2.75% from 5%. And we know President Trump would love for the Fed to cut rates, but I want you to see why it doesn't work. Because remember, the unemployment rate in Canada is 7%. There's a problem. There's a lot of people that just can't get loans. Let's take a look at the federal funds rate in blue against the unemployment rate in red. And I want you to see that when the unemployment rate starts to surge higher, that cutting rates doesn't make any difference. And you can see it very clearly in every cycle, particularly going into recession. The Fed's cutting rates and the unemployment rate is screaming higher. Now the risk right now is that the unemployment rate could start moving up and the Fed is behind the curve. They're focused on inflation. And again, why doesn't monetary policy work in this case? It's very simple. Ask those 7% of people in Canada that are on unemployment to go to the bank and get a loan. The banks are going to say no way, no job, no loan. And what we can then see is then demand around the world continue to decline. We got some data today as we take a look at West Texas Intermediate. We see crude oil inventories up 7 million barrels, while gasoline down just over 2.5 million, distillates down 825,000. What we can see again is demand from consumers is dropping as their paychecks shrink. And check out this chart. We have total crude production in blue against rig count in green. There's a problem. For every rig that goes offline that we don't see production out of, you lose around 100 to 150 jobs. While in the grand scheme of things, it's not a lot. But the fact is, the more rigs we see going down, that means fewer people working, less demand. And again, it all moves slowly and then snowballs at once. But something that could impact manufacturers and consumers all around the world. We're seeing turmoil in the copper industry as copper market in turmoil as Trump down to 50% tariff on U.S. imports. Now keep in mind the 3 biggest importers of copper into the United States are Chile, Canada, and Mexico. Again, this is going to be a major problem for U.S. consumers, as right now we're looking to see price pressure come down so they can spend more. This is going to be a problem because the U.S. does not nearly have enough mine, smelter, or refinery capacity to be self-sufficient in copper. As a result, import tariffs are likely to lead to continued significant price premiums in the U.S. relative to other regions. Again, this is going to put upward pressure on the producer price index. But keep in mind, every attempt to raise prices right now isn't working at all. And the longer-term aim of the Trump administration may be for the U.S. to be fully self-sufficient in copper, but mines take too long to develop for this to be achieved in less than a 10-year time horizon. The U.S. will still rely on foreign mines to meet demand for the foreseeable future, but again, the problem is, and we're seeing this in China, we're seeing this in Canada, we're seeing this in Europe, we're seeing this in the U.S. Anytime prices go up, consumers reject them. Now we're facing another risk. Producer prices here could go higher. But what we're seeing in China, as demand goes down, you're seeing businesses fight. They're cutting prices. The problem is that's spreading to Canada. It's happening here in the U.S. It's happening in parts of Europe. It's going to happen even on a bigger scale as demand from the pandemic goes away. The problem is, as that happens, demand for workers is going to go with it, which is why right now the world isn't ready for what's happening in China. It's an indication that their economy is screwed, but the problem is it means for the rest of us, we're not far behind. But something we're bullish on, again, is the stock for our sponsor for today's show is Upexi. Again, you can find them on the NASDAQ under the symbol UPXI, and they're the leading Solana treasury company. As a forward-thinking company building a treasury focused on Solana, it's a high-performance blockchain designed for mass adoption. And again, we're going to take a look at that chart again here in a moment because it just closed over a 6-month volume profile. It's coming out of deep oversold territory on the technicals. Could have some major upside potential. Again, that's one you don't want to miss out on. Solana, launched back in 2020, offers ultra-fast, low-cost transactions with its proof of history technology, making it a leader in active addresses, daily transactions, and decentralized exchange volumes. Its robust ecosystem supports finance, gaming, AI, and more. Upexi's strategy provides crypto exposure through familiar equity structure, improving on MicroStrategy's playbook by aggressively acquiring Solana to capitalize on its growth and enhance shareholder value. They recently acquired 100 million of discounted locked SOL tokens back in August 2024 and added more in October of 2024, demonstrating its commitment to building a substantial Solana treasury at attractive valuations. And Upexi Capital Markets Flywheel leverages large-scale accredited capital raises to acquire and hold Solana, aiming to maximize value while employing risk-prudent practices like native staking and validator diversity. With seasoned executives and a focus on operational excellence, Upexi bridges crypto and traditional finance, offering a compelling opportunity to participate in Solana's growth. And that's exactly what we're seeing in the stock chart. Let's take a look at this again, because on the technicals, you look at the RSI and the MACD, what do you see? They're coming out of deep oversold territory. Technical traders love that. But what I also love is the fact that it held its 6-month volume profile. You can see it's now closed above it, looking to rally. A potential break above its 200-day moving average could send it all the way up into that upper supply zone, and that could realize a potential massive gain. Again, this is something you don't want to miss out on. You can find them on the NASDAQ under symbol UPXI. And you can visit them at upexi.com to learn more about how Upexi is positioned to capture value in the expanding crypto market with Solana at its core. And again, be sure to check them out on the NASDAQ under symbol UPXI. And as always with any company we feature on our show, you're under no obligation to purchase their stock. Be sure to do research before placing any trades. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.